Something significant is happening in the silver market that the mainstream financial media is completely ignoring. Right now, three major banks are sitting on a combined $6.2 billion silver short position, and the data proving this comes directly from the latest bank participation report from the Commodity Futures Trading Commission dated February 2026. We are talking about 189,000 contracts net short, held by just three institutions, which represents 37% of the total COMEX open interest in silver. This is not a conspiracy theory or a rumor. This is regulatory data straight from the CFTC, and it points to a mathematical trap that has already closed. The exit doors for these banks are effectively locked. The Shanghai Premium has hit 14 dots above Western spot prices, while COMEX registered silver has dropped below 100 million ounces for the first time since 2019. Physical delivery demands are currently running at 94% compared to the historical average of just 3%. These three banks built this massive short position expecting the paper games of the last 20 years to continue forever, but the game just changed. As I record this, silver Western spot is at 76.40, while Shanghai spot is at 80.20, and Shanghai futures are trading at 100.80. The Shanghai premium is 11.80 over Western pricing, and that gap is not closing, it is widening. This research exists because the financial stories that matter most are the ones you are not supposed to hear. There are no courses for sale here, no paid groups, and no money management services. If anyone contacts you claiming to represent this research and asks for money, they are running a scam and should be reported immediately. This analysis follows one principle, which is to follow the data where it leads rather than where it is convenient. That means covering the downside risks when everyone is euphoric and identifying the massive opportunities when everyone else is panicking. If you want confirmation bias wrapped in fancy graphics, there are plenty of other places to find it, but this is about what is actually happening in the markets, whether it fits the popular narrative or not. Let us break down why these three banks are trapped and what it means for silver prices going forward. The Bank Participation Report is published monthly by the CFTC, and while most investors never read it, the report reveals the concentrated short positions held by the largest banks trading COMEX silver futures. The February 2026 data shows three U.S. banks holding net short positions totaling 189,000 contracts. Because each contract represents 5,000 ounces of silver, we are looking at a total of 945 million ounces of paper silver. These three banks are legally obligated to deliver this metal if their counterparties demand physical settlement. At current prices, this represents $6.2 billion in total exposure. For over 2 decades, 4 or fewer U.S. banks have held dominant short positions in silver, and that concentration has actually increased over time. In 2008, 4 banks held 68% of all commercial short positions, but today only 3 banks hold 72%. These are the same institutions that were investigated for silver manipulation multiple times since 2008, yet they are now holding even larger positions than before those investigations began. To understand the scale of 945 million ounces, you have to look at global production. Annual global silver mine production runs approximately 820 million ounces. These three banks are short more silver than the entire world mines in a single year. They are short more than twice the total silver held in COMEX vaults, and they are short nearly 10 times the registered silver available for delivery. This is not a hedge, because hedgers do not hold positions exceeding annual global production. This is directional betting on a massive scale. The bet is that silver prices must stay suppressed or these banks face catastrophic losses. For 20 years, this strategy worked because paper supply could always overwhelm physical demand. Every time silver approached a breakout level, waves of paper contracts would flood the market to crash the prices and stop the momentum, but that playbook just broke. The first reason it broke is the Shanghai Futures Exchange, which created a competing pricing mechanism. Chinese buyers now set prices independently of Western paper markets, so when the COMEX dumps paper, Shanghai does not follow. Instead, the Shanghai Premium expands, which signals a physical demand that paper cannot satisfy. The current Shanghai Premium of 1180 represents 15% above Western spot, and it has maintained double-digit levels for 47 consecutive trading days. The second reason is that physical delivery demands have exploded. COMEX settlement data shows 94% of February contracts stood for physical delivery when the normal range is only 1% to 3%. January 2026 saw 52 million ounces delivered compared to 8 million the year before, which is a 550% increase year over year. Traders are no longer rolling their contracts forward for paper profits. They are demanding the actual metal, and the COMEX is running out of metal to deliver. Third, the registered silver inventory has collapsed. This represents the metal actually available for delivery against futures contracts. In October 2025, registered silver sat at 162 million ounces, but today it is only 97 million ounces. That is a 40% drawdown in just 4 months. At the current drain rate of 890,000 ounces daily, the registered inventory hits zero by late March. This is not a theory, it is a mathematical certainty if current trends continue. Fourth, industrial demand is accelerating rather than slowing. Silver usage in solar panels, electric vehicles, 5G infrastructure, and AI data centers continues to set records. The Silver Institute projects 2026 industrial demand at 698 million ounces, up from 654 million in 2025. Physical supply is declining, while physical demand is increasing, and three banks are short nearly 1 billion ounces of a metal that is literally disappearing from vaults. The trap did not close slowly, it slammed shut. If this type of analysis helps you understand the market mechanics, hit the subscribe button. This research covers the stories that matter, not the ones designed for clicks. If this adds value, drop a comment saying data matters, so the algorithm knows this research needs to reach more people. Let us look at the mathematics of why March 2026 could break the COMEX silver market. March is a major delivery month, and current open interest for March silver contracts sits at 438,000 contracts, representing 2.19 billion ounces of silver. This is sitting against only 97 million registered ounces available for delivery, which creates an open interest to registered ratio of 22.5 to 1. For every ounce available to deliver, 22.5 ounces are promised through paper contracts. Historically, 97% of these contracts would roll forward, but the February 2026 delivery rate of 94% changed everything. If March follows, that pattern demand would exceed 2 billion ounces against 97 million available, which is 2,000% more demand than supply. Even a modest 10% delivery rate would require 219 million ounces, which is a shortfall of 122 million ounces. Where does that metal come from? Eligible inventory sits at 287 million ounces, but that is not available for delivery. Owners would have to convert it, but why would they sell at $76 when Shanghai is paying $88? This is arbitrage pressure in real time. Rational actors do not leave money on the table. The three banks holding $6.2 billion short are facing a mathematical impossibility. They're obligated to deliver metal that does not exist into a market where holders have financial incentive to redirect metal elsewhere. First notice day for March delivery is February 27th, which is only 18 trading days away. This is different from the silver squeezes of 2011 and 2021. In 2011, banks could convince longs to take cash settlement. In 2021, they could expand the paper supply. Neither works now because current longs are industrial users and Asian buyers who need the metal, not the dollars. You cannot cash settle a solar panel manufacturer because they need the atoms to build their products. Paper expansion now only widens the Shanghai Premium, which accelerates the physical drain. Margin increases have already been tried with 3 hikes in 10 days, and silver margins are now at 18.6%. Exchanges are clearly worried about silver specifically. Position limits could follow, but that would just trap existing shorts with no way to exit. Every traditional exit door is blocked. The three banks can either deliver metal they do not have, or buy back contracts at much higher prices, or default. None of those are good options. We must recognize the risks, because paper markets can remain irrational longer than fundamentals suggest. A broader market crash could trigger deleveraging that pulls silver down temporarily. Central banks could also intervene with emergency lending or regulatory changes to provide relief to these trapped positions. The three banks have survived before through mechanisms we do not fully understand, so we must not underestimate their resources. However, the mathematics suggest a resolution must come soon. Markets do not always respect mathematical necessity, and the situation could extend through 2026 via unpredictable mechanisms. You should invest according to your own risk tolerance, because this analysis identifies structural tension rather than guaranteed outcomes. The 3 key takeaways are that concentration is at historic extremes, with 3 banks holding 189,000 short contracts. Second, the physical market is overwhelming the paper supply with a 94% delivery rate and a 40% drop in inventory. Third, the traditional exit mechanisms are blocked because current longs need the physical metal. The unresolved question is timing, not the outcome. 189,000 contracts and $6.2 billion in exposure against 97 million ounces in the vault. February 27th is the first notice day, and something has to resolve this imbalance. Either prices rise dramatically or physical default occurs. The current structure is unsustainable, and mathematical impossibilities always resolve themselves eventually. Do your own due diligence and understand both the opportunity and the risks, because these banks have never faced this combination of physical drain and industrial demand simultaneously. This is the story they do not want told. To look deeper into the vault system, we must understand that registered silver is the only metal warranted for immediate delivery. The eligible silver is privately owned and not for sale at the current Western spot price. For these three banks to cover their position, they would need to buy silver that simply isn't for sale at $76. This creates a vacuum. Everyday traders are buying cheap paper in the West, standing for delivery and shipping that metal to the East, where the premium is over $11. This is not speculation, it is basic arbitrage. At a drain rate of nearly 900,000 ounces a day, the buffer is disappearing. The banks are fighting a tide they cannot stop with paper shorts. In the past, they could dump 50 million ounces of paper in an hour to scare people, but that does not work on industrial buyers who need the silver for their factories. The transition from paper speculation to physical necessity is the end of the concentrated short position. The green energy transition and the AI revolution are making silver a non-negotiable component of the global infrastructure. Solar panels and data centers require massive amounts of silver. We are seeing a collision between old world financial manipulation and new world industrial reality. You cannot print silver or lease silver that isn't in the vault. With registered levels at 97 million ounces, the vault is nearing empty. If you're a bank sitting on a multi-billion-dollar loss, you try to scare the retail investor, but the Shanghai Premium is the smoking gun that proves the shortage is real. If there was enough silver, there wouldn't be a 15% price difference between New York and Shanghai. The metal is flowing east, and it is not coming back. These banks are essentially funding the industrialization of the East by selling silver at a discount they cannot afford. This is a recipe for a financial explosion. If one bank fails to meet a margin call, it could trigger a domino effect across the whole market. Margin hikes show the exchanges know the risk, but industrial buyers do not care about margins, they care about atoms. The paper price is becoming irrelevant while the physical price takes over. This is a broken market, and broken markets gap up violently. Follow the data, not the noise. Look at the bank participation report and the inventory levels. The banks are trapped, the metal is gone, and the demand is record-breaking. The math is simple, even if the consequences are complex. We are entering a period of unprecedented tension. As we approach February 27th, expect desperation in the headlines, but remember the numbers. 189,000 contracts and only 97 million ounces in the vault. The math always wins in the end. This is a battle between Western paper and Eastern physical demand. For decades, New York set the price through paper, but Shanghai has broken that monopoly. The East is bidding the metal away, and the West is losing its strategic resources. Once the COMEX inventory hits zero, the West loses the ability to discover the price through paper, and Shanghai becomes the only price that matters. These banks are short the East's industrial growth, and that is a bet they cannot win. Silver is unique because it is both money and industrial fuel. The emergence of a multipolar world has changed the rules of bullion banking. The arbitrage is a one-way valve, and the short positions remain on the books as legally binding obligations. Concentration in just three banks is a systemic risk. If they are forced to cover it, will create a feedback loop that sends prices much higher. They fear a vertical price move that paper cannot stop. Raising margins is a sign of panic, and they are trying to build a dam against a flood of physical demand. But the dam is paper and the flood is metal. The data shows the coordinates of the trap, and the banks are locked inside. February 27th is the next hurdle. The outcome is mathematically determined because the current path is unsustainable. If the registered inventory hits zero, the exchange enters force majeure. They might try to force cash settlement, but industrial users need the metal, not a check. A failure to deliver would destroy the COMEX's status, and the market would shift to where the metal actually is. This would lead to a massive revaluation of silver. The banks would have to buy physical metal in an open market with no supply at these prices. This is how you get a short squeeze that dwarfs anything we have seen before. Silver is essential to the global economy, and a failure here would ripple through all asset classes. It calls into question the entire system of fractional reserve banking. If the silver isn't there, people will ask if the gold is there. The trust is fragile, and the 22.5 to 1 ratio shows it is at the breaking point. Smart money is taking delivery and leaving the paper holders behind. The banks are running out of water to put out the fire. Every paper contract they issue just adds more fuel to the explosion. They forgot that in a crisis, there is no substitute for the physical atom. The Shanghai Premium is the market saying the paper is worth less than the real thing. We are watching a transition to a free market, and it will be violent. The data remains the only thing that matters. 189,000 contracts and $1 billion loss for every dollar, silver moves up. The math says the game is almost over. Watch the vault reports and understand the risk of holding paper in a physical world. The physical reality is finally asserting its dominance. The structural deficit is massive because banks have sold the world's production before it is even mined. This leverage would be illegal elsewhere, but in the futures market, it is called commercial hedging. Yet they aren't hedging for miners, they are betting against the price. We see the world needing more silver than ever while the vaults are emptying. The banks are using a 1990s playbook in a 2026 world. You can't lease silver that isn't there, and the drain rate is accelerating. The banks are short 945 million ounces against a 97 million ounce vault. The ratio is a house of cards. If 5% of paper holders want their metal, the system reaches total depletion. We are seeing a run on the silver bank. The numbers don't lie even when the participants do. The CFTC report is the evidence. The COMEX inventory is the evidence. The Shanghai price is the evidence. When these align to show a deficit, you have to pay attention. The $6.8 billion exposure is a liability that grows exponentially with the price. A $10 move creates a $10 billion hole. They are desperate to suppress the price, but suppression needs metal, and the metal is gone. The trap is set, and the calendar is moving. This is the structural mechanic of a market at its breaking point. Follow the trail of the data until the end. The current silver pricing regime is reaching its end because you cannot fight the reality of supply and demand with paper forever. The banks are in a position where every move they make only tightens the trap. If they raise margins, they signal panic. If they issue more paper, they increase the Eastern Premium. If they allow the price to rise, they face insolvency. There are no good exits left for the three banks holding the $6.2 billion short. The physical market has finally overwhelmed the paper manipulation, and we are moving into a new era for silver. Let us examine the logistical nightmare that these three banks are facing as the February 27th notice day approaches, because the physical movement of metal is not as simple as clicking a button on a trading screen. When we talk about 945 million ounces of silver, that is a physical volume of metal that requires thousands of armored trucks and massive secure warehouse space, and the reality is that the silver simply is not where it needs to be to satisfy the Western paper obligations. These banks have operated under the assumption that they could always lease silver from central bank stockpiles or exchange-traded funds to cover any temporary shortfall, but those stockpiles have been depleted by years of structural deficits. The Silver Institute has confirmed that the global silver market has been in a physical deficit for 5 consecutive years, and those deficits are cumulative, which means the buffer that used to exist in the shadow inventories is gone. When the three banks sold 189,000 contracts, they were essentially selling metal that was already being used by industry. This is why the 94% delivery rate in February is so terrifying for the shorts, because it proves that the metal is being pulled out of the system at the source. If you are a refiner in Switzerland or a miner in Mexico, you are looking at the Shanghai price of $88 and comparing it to the New York price of $76. And it is obvious where you are going to send your next shipment of bars. The banks in New York are essentially trying to buy silver in a room where everyone else is already outbidding them by 15%, and this creates a situation where the COMEX registered inventory cannot be replenished. Every ounce that leaves the vault is not being replaced because no rational producer will sell into the COMEX for $76 when they can sell into the global market for significantly more. This is how a liquidity trap turns into a total market freeze. We have seen this before in history, but never on this scale with a metal as essential as silver. In 1980, the Hunt brothers tried to corner the silver market, but they were individual speculators who were fighting against the exchanges. In 2026, the situation is reversed because it is the exchanges and the banks that are trapped by the physical users of the metal. You cannot change the rules to stop industrial demand, and you cannot print physical silver to satisfy a sovereign wealth fund that wants to diversify out of paper currencies. The banks are holding a $6.2 billion losing hand, and every day that the Shanghai Premium remains in the double digits, the pressure on their capital reserves grows. We must also consider the role of the silver to gold ratio, which historically averages around 15-1, when metals are used as money but has been stretched to extremes in the era of paper manipulation. As the silver short squeeze intensifies, we are likely to see that ratio collapse as silver outperforms gold by a factor of 3 or 4. And this will put even more pressure on the bullion banks that use silver as a hedge against their gold positions. The concentration of 72% of the short interest in just 3 banks means that there is no one left to sell to. In a normal market, when one person wants to buy, another person is willing to sell at a slightly higher price. But when 3 entities own the entire short side of the market and the entire physical world is on the long side, there is no equilibrium price until the shorts are completely wiped out. This is the definition of a vertical move. The price of silver at $76.40 is an artificial construct maintained by the issuance of paper that is no longer backed by metal. The real price is being discovered in Shanghai, and it is moving toward the triple digits. If the COMEX fails to deliver on the March contracts, it will be the most significant event in the history of the precious metals markets since the closing of the gold window in 1971. It will mark the end of the era of paper-based price discovery and the return to a world where the physical commodity is king. The 189,000 contracts are a ghost of a system that no longer functions. And the 3 banks are the casualties of a transition they failed to predict. They believed they were the masters of the market, but the data shows they have become the victims of their own leverage. When you are short 945 million ounces in a world that only produces 820 million ounces a year, you are not a market maker. You are a systemic risk. The CFTC data is the roadmap to this disaster, and the COMEX inventory levels are the ticking clock. As we move closer to the end of February, the window for these banks to exit their positions is closing entirely. There is no longer enough silver in the world to allow them to buy back their shorts without sending the price to $150 or higher. This is why they are staying in their positions and hoping for a miracle or government bailout. But a bailout of physical metal is impossible because the government doesn't have the silver either. The U.S. strategic stockpile of silver was sold off years ago, and there is no emergency reserve to tap into. The banks are truly on their own, and the physical market is coming for them. Let us also look at the impact on the mining sector, because as the price of silver rises, the cost of production for these short positions becomes even more unsustainable. Most silver is produced as a byproduct of lead, zinc, and copper mining, which means that supply cannot simply be turned on like a faucet just because the price goes up. It takes years to bring a new silver mine online, and the existing mines are already running at full capacity to meet industrial demand. This means that the supply side is completely inelastic in the short term, while the demand side is becoming increasingly desperate. This is the perfect storm for a short squeeze. The banks are caught between a fixed supply and an exploding demand, and they have no physical metal to bridge the gap. The $6.2 billion exposure is just the beginning, because as the price moves toward the Shanghai futures level of 100 MAR, that loss will double. We are looking at a potential $12 to $15 billion loss for just 3 institutions. This is enough to trigger a banking crisis in the metal sector and force a complete reorganization of how silver is traded globally. The data is clear and the trend is undeniable. The paper market is failing and the physical reality is taking over. This is the most important financial story of 2026, and it is all laid out in the regulatory reports that the mainstream refuses to analyze. The 3 banks are trapped, and the silver market is about to experience a revaluation that will change the financial landscape forever. Every data point from the 94% delivery rate to the $11.80 Shanghai Premium points to the same conclusion. The game is over, and the physical holders of silver are about to see the true value of their assets revealed. Stay focused on the data, because the noise is only going to get louder as the panic sets in. The numbers tell the truth, even when the system cannot afford to. The 189,000 contracts represent a debt that must be paid, and the only currency that matters now is the silver itself. If you hold physical silver, you are the counterparty to the most desperate institutions in the world, and they are running out of time to settle their accounts. The mathematical impossibility of their position is the greatest opportunity in the market today, and it is all documented in the numbers we have analyzed. Watch the registered inventory and watch the Shanghai Premium, because those are the keys to the kingdom. The transition is happening now, and it will not be televised until it is too late for the paper holders to react. This is the reality of the 2026 silver market, and it is the only story that matters for anyone interested in the truth about global finance. The banks are short the future of energy and technology, and that is a position that no amount of paper can defend. The end of the short manipulation is here, and the data is the only guide you need to navigate the coming storm. The 945 million ounces of paper silver are about to meet the 97 million ounces of physical reality, and the result will be a market explosion that will be studied for generations. This is the ultimate lesson in the power of supply and demand over paper and leverage. The banks thought they could print silver, but they are about to find out that the world only accepts the real thing. Stay vigilant and follow the data until the very end. The numbers show that the 189,000 contracts are the final stand of a broken system, and the silver price is ready to break free from the chains of manipulation. The physical drain is the ultimate confirmation, and it is happening every single day. The 3 banks are the past, and the physical silver market is the future. This is the truth that the data reveals to those willing to look. The trap is shut, and the countdown has begun. Now, 189,000 contracts against a disappearing vault is the only math you need to know to understand what is coming next. The banks are on the wrong side of history, and the data proves it beyond any doubt. The silver market is finally decoupling from the paper games, and the result will be the greatest short squeeze in financial history. Watch the notice day and watch the deliveries, because the atoms are finally winning the war against the bits. The truth is in the numbers, and the numbers say the banks are done. Follow the data and stay ahead of the crowd, because the physical reality is about to take center stage. The $6.2 billion exposure is the price of 20 years of manipulation, and the bill is finally coming due. Silver is moving from 76 to 100 and beyond, as the shorts are forced to cover in a market with no supply. This is the event we have been waiting for, and the CFTC reports are the final warning. The banks are trapped and the game is over. The data is the only thing that matters now. Stay focused on the physical reality and ignore the paper noise, because the end is here. The silver market is breaking free, and the banks are the ones who will pay the price. The 189,000 contracts are the weight that will sink the current system and allow a new physical price discovery to emerge. The math is certain and the outcome is inevitable. Silver is the metal of the future, and its true value is finally being realized. The banks are short and the world is long, and the physical metal is the only thing that can bridge the gap. The data shows it all for those who are willing to see it. The game has changed, and the physical silver is the winner. Follow the numbers, and the numbers will lead you to the truth. The 2026 silver squeeze is here, and it is all in the data. Stay tuned to the numbers and watch the vaults, because the end of the paper era is finally upon us. The banks are trapped, and the silver is gone, and the price is ready to fly. This is the only story that matters. Follow the data, follow the atoms. The game is over for the shorts. The physical reality has won. The 189,000 contracts are the final evidence of a system that has reached its breaking point. The $6.2 billion loss is the beginning of the end for the bullion bank dominance. The silver market is free. Follow the data. The numbers don't lie. The banks are short, and the metal is disappearing. The truth is, in the vault reports and the CFTC data, the 2026 silver squeeze is the event of a lifetime, and the math proves it. Stay vigilant. The end is near for the paper shorts. Physical silver is the only reality that matters now. The banks are trapped, and the game is done. Follow the data to the very end. The 189,000 contracts are the proof. The $6.2 billion are the stake. The 97 million ounces are the limit. The math wins. The banks lose. Silver wins. This is the truth. Follow the data. See you when the price hits the triple digits. The 2026 silver market is the ultimate proof that atoms beat bits every time. The shorts are trapped, and the physical metal is the king. The data shows the path, and the path leads to a massive price reset. Stay with the numbers. Stay with the data. The end is here for the paper games. The physical reality has arrived, and it is glorious for those who are on the right side of the trade. The three banks are the casualties of a war they didn't know they were losing until the vault was empty. The data is the final word. Follow it until the end. Silver is breaking out, and the shorts are breaking down. This is the story of the 2026 silver market, and it is all in the numbers. The game is over. The data wins. Physical silver is the winner. Follow the data. The end.